Good morning. Welcome to America First Wealth Management Investment Outlook for Monday, October 21st, 2024. My name is Dan Liu. I'm the Chief Investment Officer and Portfolio Manager at America First Wealth Management. Joining me once again is Michael Cheah, our Head of Fixed Income and Portfolio Manager. Welcome, everyone. Next slide, Mike. This is just our standard disclaimer. We're not offering any investment advice here. We're just talking about our views on the markets and outlook, and our data is subject to change as market conditions and information changes. Next slide, Mike. So we like to begin by giving our market outlook summary first and then providing additional data. So this week, I have a more extensive market outlook because there's a lot going on here, and markets are increasingly focused on the presidential elections as they're coming up in a few days on November 5th. Last week, there was a lot of buzz. The betting markets are overwhelmingly predicting a Trump victory. However, poll-based election models are split, and the national polls give Harris a slight edge. Looking at some of the billionaires out there, Stanley Druckenmiller pointed to the outperformance of bank stocks and cryptocurrencies, and beneficiaries of what we call the Trump trade promises to reduce regulation. So in the area of bank stocks and cryptocurrencies, that's seen some positive action. Another hedge fund billionaire, Dan Loeb, who manages Third Point Capital, he indicated that he's positioning his portfolio in a Trump trade here. So that's kind of interesting to see real money, both in the betting markets and by hedge fund investors, pointing that out. I'm also going to point out some market data, and the question is, how well is the S&P 500 predicted the presidential outcome? Since 1928, the incumbent party won in 12 out of 15 elections when the S&P 500 was up in the 3 months prior to the election. And the incumbent party lost 8 out of the last 9 times when the market was down in the 3 months prior to election. And I do want to point out for the last 3 months, the S&P 500 is up 5.8%. So that leans towards the incumbent party. However, the incumbent party, in terms of the actual person, is not the same person that's running. Obviously, Biden had stepped down, and Kamala Harris has won the nomination for the Democratic Party. So that's just looking at market averages. That's kind of data. Very, very interesting headline, and some rhetorical comments that we've heard is that there's a lot of election anxiety out there, and that might have an impact, particularly on large ticket item purchases prior to the election. Another major market action and information that happened during the week was nuclear power is now a big topic of discussion. Both Google and Amazon signed some deals to move forth in the area of modular small modular reactors for nuclear power. Now it's quite interesting. This week's earnings, a lot of companies reporting. About 23% of the S&P 500 companies are reporting this week. That's 114 companies. So far, earnings season has been quite constructive, and we do expect tech stocks to lead earnings growth for the third quarter. I do want to point out that the big bellwether everyone will be watching is reporting later. NVIDIA will be reporting their earnings on November 14th. Pointing out the key macro data points to watch this week, mostly on Thursday with initial jobless claims, home sales, and energy inventory information. And on Friday morning, we have durable goods orders. Next slide, Mike. So I took the liberty of collecting the betting markets on the presidential elections. We've got Polymarkets, Betfair, Kashi, Predicted, and S Markets. They're all overwhelmingly bettors are predicting that Trump wins by a margin, pretty strong margin, above 60% for Polymarkets and high 50% predicted win rate in the other betting markets. Next slide, Mike. And I did a collection. I thought this was rather interesting and iconic. I've never seen a more animated and uh, let's say action-oriented presidential candidate in history. And this was a collection of pictures that I just pulled off the internet. And this is spurred by the last picture on the bottom right. Yesterday, Trump was in Pennsylvania, cooking up French fries and serving customers. Obviously, it was somewhat staged, but it was probably pretty interesting. And as some commenters said, that kind of blew up the internet and got him a tremendous amount of views. And he's clearly making a very strong push in the state of Pennsylvania as we close in on the elections. Many pundits are predicting that who wins Pennsylvania is likely to win the election because of the electoral votes in that state, and it's a very important swing state. And just kind of commenting quickly on the pictures, there's a top left is Trump's mugshot, and then he was in court with the big trial back in April. In July, the assassination attempt. The next day, he went out and played golf. And then also recently, he appeared at the Alfred Smith um, benefit event, which his opponent Harris did not appear at, and I think that may prove to be a bad mistake on her part, as the Catholic population represents about 22% of the vote in the country. So it's pretty interesting what's going on here. I think the betting markets are, and then the actions, I think, are clearly leaning towards a Trump victory. But to be fair, who knows? Who knows if money or what the people, how the money's betting versus how the people actually vote, um, will be, one will be predictive of the other, or the vote will be a complete surprise. So, in any event, we are telling our investors and ourselves, be prepared for anything on election day and the day after. So, in the meantime, I think the trend is your friend. Ride the trade that seems to suggest the Trump victory, but be prepared for extreme volatility as election day approaches and the day of and the day after. Next slide, Mike. This is a headline I saw that was interesting. I can't buy a house. I can't shop. I'm too worried about the election. And this just kind of highlights the election anxiety. And I think a lot of people are watching the elections versus going out shopping. Um, and as one former car dealer said, every 4 years this happens. And given the level of publicity and attention this is causing, we wouldn't be surprised if this will have an impact on large ticket retail and housing uh, purchases here. So something to note, and it could be an outlier. Um, and after the elections, things could reverse, hopefully for the positive. Next slide, Mike. So this is my Back to the Future slide, and this highlights the Amazon agreement that they signed with Dominion Energy, which was a stock we talked about a couple of months ago because of specifically for the Amazon deal. Now they're moving to sign agreements for nuclear energy projects. Google doing the same, announcing to buy power needs for their AI server farms from a small modular nuclear reactor company called Kairos. So a lot of investors are looking at the nuclear industry again, engineering and construction companies, small modular nuclear reactor component suppliers, uranium companies. So that's a pretty interesting area to look for new ideas. Next slide, Mike. Turning to weekly market stats, I added the 3-month return column here next to the quarter to date and before the year to date. You can see 3-month returns are all solidly positive. For the last week, we've got pretty strong results for the market. The exception being the NASDAQ 100, which was down a little bit, and international stocks also down a little bit. but mostly everything solidly in the black. The month to date and quarter to date, which are both the same or also up. Bonds are down for the month to date. Year to date, everything is in the green. Um, Investors should be pretty happy with results so far. As in the prior week, I pointed out that the bull market is now 2 years old, and the average bull market has extended 5.5 years. We still see no reason for the bull market to end abruptly, given the previous longevity of bull markets. But again, we do expect some volatility clearly as we enter the election on November 5th. Next slide, Mike. S&P 500 continue to trend up above the 10-day moving average. The RSI at the bottom is is looking a little bit overbought, but not beyond the extreme point where we would be concerned about a pullback. So we probably will continue bumping along here, riding the Trump trade and positive earnings reports. Next slide, Mike. Turning to fixed income, 10-year yield continues to back up, and congrats to Mike for predicting that outcome after the Fed Reserve 50 basis point rate cut. So 10-year yield continues to back up. For the week, however, it was flat, ending at 4.08 versus 4.08 for the prior week, and we're up 20 basis points year to date. Next slide, Mike. Turning to yield curve, we've simplified it a bit here, just showing last Friday's yield curve in the blue. You can clearly see the backup in rates at the longer end from 5 years out, and the shorter end having declined. But even the shorter end is a bit above the end of prior quarter ending September. So interesting changes in the yield curve. I still think that we're seeing the yield curve steepen and becoming positively sloped, but now it's starting to feel like it's the longer end that's rising and the shorter end that's falling. However, as Mike will elaborate, the Fed will run the risk of heightening inflation concerns if they continue to cut at the short end. Next slide, Mike. The 10-2-year spread had widened sharply, pulled back a bit, but starting to widen again. As you can see, the 10-day moving average has turned up and the chart has turned up. So the spread is starting to widen. Next slide, Mike. Turning over to Mike here.
Okay, thanks, Dan. Well, very easy conclusion for me. I see data showing that the economy is growing from strong to even stronger. And wage inflation could fast become headline news, and the market would focus on inflation again, especially wages. So this is the retail sales before this inflation, before the election anxiety. So we are seeing very strong numbers. And when we look at so let me back a bit. So here, maybe next month, after election, when we get the result of this recent month retail sales, we might see a dip, right? And subsequently, we may bounce back again, because when we look at the personal income, less transfers, receipt, inflation adjusted, we see that the revised numbers are a lot higher, and that means that there is a lot of spending power, right? The question is when do the consumer start spending again? And part of this was also surprised that we see that the payroll has been revised from the numbers September 6 to the numbers in October 4. We see a departure from our previous expectation of continued decline in the job situation to a U-turn. And the Fed Atlanta GDP now model is showing extremely strong growth. We are looking at 3.2% here, which is a lot higher than the range of the blue chip consensus. So this leads on to inflation and the Boeing workers are getting 35% over 4 years, and this worked out to be like 7.9% compounded annual growth rate. And this is on top of the wage increase that is being negotiated at the dock workers. Dock workers are expecting to be getting about 8.9%. So if this continue, I'm sure that there are a lot of steel workers who say, I want to pay rise. A lot of teachers say, I want to pay rise. Right? It only makes sense for people to reach out to their union leaders and say, what have you guys been doing for lately? And let's try to get an 8% pay rise over the next 3, 4, 5 years. So that could be a problem. That could be a problem for the Fed. And when we think about the backdrop, where they have cut rate at a time when the job market was still very strong. Okay, like we still have a labor shortage, and now we are seeing this natural wage increase. But the good news is that in terms of inflation expectation, when we look at the 1 year median, right, we see that it's pretty much under control. The next shoe to drop could be a greater demand for global commodities, and that would fit into imported inflation here in the US, and that could come from a rebound in the Chinese economy. So here, according to this survey, there is now a major U-turn in terms of net percentage of the money managers seeing a stronger Chinese economy. And this expectation is backed by recent news that China may raise $846 billion to boost growth, and China $562 billion loan push for unfinished homes disappointed some people, but still, this is up. It's an increase, and so that could help to push up the overall demand from China. And here is a good example of bad news is good news for the Chinese stock market, because China's Q3 GDP hit weakest pace since early 2023, and this backs call for more stimulus, right? And as we have seen, the latest move is China plan to support the financial markets after the data showing the economy have slowed. So this leads us on to the bond market, and we are seeing that dealers are short investment grade bond. So the question is that are they shorting this because they are seeing that the economy will go into recession soon, or are they seeing that we are going to have an inflation problem in the near future? Or maybe they're shorting the investment grade bonds because they expect an increase in treasury bond yield. And here we see that the net interest payment for our federal debt has gone up very sharply indeed. And when we look at the average interest rate, it's gone up, but not as high as it was in 2006. So if we do go back to this, net interest payment would go even higher. So this could be one of those vicious cycles where the fear that the US is paying a lot more in interest payment lead to market higher interest rate, and that in turn leads back to interest payment, all because the debt held by the public continue to go up. And just repeating myself, that both the candidates have not put any focus on controlling the total federal debt. And then our friend TLT tried to bounce, but it failed. And as we see early this morning, pre-market trading, the 10-year and 20, 30 years have moved up in yields again. And moving on to gold, which is many people still regard gold as a good inflation hedge. And now we are seeing more central banks talking about buying gold. And when I look at countries like Mexico, Mongolia, Czech, these are not the countries that are in the past been very active in reserve management, like the Chinese, Brazilian, and Russian, right? So it's interesting that this notion of central bank buying gold is spreading to the other central banks as well. And I thought this is interesting, and I want to set the stage for Dan to follow up. What we are seeing is that gold price have hit the record high, but the major gold mining companies have not moved up as much. So Dan, back to you.
Sure. Yeah, Mike and I were talking about the lag in the gold mining stocks versus the rise in the gold prices. And my thinking and understanding of valuations is that gold mining stocks could be potentially undervalued by as much as 50%. So if the gold mining stocks do take off to reflect the high price in gold, there could be considerable upside here. Also, my history of gold mining stocks is many of these gold miners utilize diesel fuel to power the equipment and energy needs at their mines. So price of crude oil has been dropping as well as diesel prices. So cash flow at gold mining stocks obviously looks to be very strong given the lower energy prices and the high gold prices. So those are very favorable fundamentals here. But taking a step back, and Mike, maybe we can have a little discussion about this. I can't help but feel that regardless of who wins the presidential election, both candidates' policies suggest they would be inflationary. Both want higher tariffs against China, which ultimately increases consumer prices. And that's one factor. Both candidates have promised increasing wages, and I think the Trump plan to eliminate taxes on tips, which also Harris has copied, and also Trump has proposed eliminating taxes on overtime pay and eliminating taxes on Social Security income. While that increases net take-home pay for everyone in those categories, it does tend to be inflationary with that increased spending power. And also, I can't help but think that with the public debt being so high, and we've talked about this over the years, the only way to get out of the high public debt is to have inflation and pay back that debt with cheaper dollars. So that's a way to reduce the debt by basically cheapening the value of the dollar. And obviously, we're seeing that being reflected in the increase in gold price and purchases of gold by many central banks. So I think investors are probably missing that point. I think it's a huge opportunity Inflation doesn't have to be necessarily bad for stocks because, as we know, many companies can pass their increased costs and and raise prices, which, if they can control other costs, they will ultimately reap the benefits of higher cash flow and higher earnings as a result. However, it may not be great for the bond market.
Mm,
Uh, However, as you've alluded to, there still are opportunities to play the bond market, and knowing how the shape of the curve is changing creates huge opportunities for adding value in bonds. And for those worried about stock market volatility, obviously bonds are a very safe place to um, protect your wealth. And also at this point, with rates being where they are, there's a pretty good yield on bonds. So a lot of interesting dynamics. I think the um, investors and consumers obviously concerned about inflation, but from the investment standpoint, I think there'll be opportunities in both fixed income and equities given these dynamics. So anyway, turning to the next slide, let's just move back. Two stocks, the Magnificent Seven, which we've been following for many, many weeks now. Had a very good week last week, with the exception of Meta. It was kind of interesting. The tech stocks weren't that strong for the week, but the Magnificent Seven stocks, by and large, continued to lead the charge, reversing the previous trend of a couple of weeks of negative returns from Magnificent Seven. Could be a function of moving into earnings week, earnings season, and seeing these companies being bought up by investors, anticipating good earnings. Next slide, Mike. U.S. sector performance, despite the slide, no change in 10-year rates. Utilities and real estate and financials, which tend to be driven by interest rate changes. Those are the three top performing sectors for the week. I think that comes on the back of very strong financial performance by the financial sector companies last week, and also taking up the real estate and utility sector. Utility is obviously, with some of the discussion going into nuclear, and indicative of the continued strong and high demand from data centers, particularly in the AI space. So utilities clearly benefited from that rhetoric that was out there. Energy was the only sector that was down for the week, with the continued drop in energy prices. Healthcare was the only other sector that was down for the week, but everything else was up. And that's it for sector performance. Turning to the next slide, Mike. We're doing something different this week. We dropped the factor um, uh, uh, analysis, and we also dropped the commodity discussion. Next week we'll be returning to that, but we'll be showing these things graphically versus in tabular format, which I think the graphical trending information is a little more informative, but we'll come back to that next week. Turning to the macro data, this is just a summary. I'm not going to go through all these. We're just going to flip through to the more important items. We've got some Fed speeches on Monday, today, tomorrow, and we begin also to get the oil inventory changes tomorrow afternoon. Next slide, Mike. Wednesday is the typical mortgage data and energy and home sales data, which will be important to watch. Next slide, Mike. Thursday, we've got the bulk of the important data coming out: initial jobless claims, Chicago Fed activity. Got some manufacturing data, new home sales. Those will be important to watch, and certainly market moving. Next slide, Mike. And on Friday, durable goods orders, which will be pretty important, give us an idea of businesses and manufacturing companies. And we also have Michigan consumer sentiment on Friday as well. And turning over to S&P 500 earnings. As I mentioned, 114 companies reporting this week. I'm not going to mention all of them, but it's pretty much across the board, mainly in industrials, but we also have some defense companies, some consumer companies, telephone companies, some insurance companies as well. So a lot of information, mainly beginning on Tuesday. On Monday, we just have 3 companies reporting pre-market. But Tuesday, you see a lot of companies reporting pre-market. Next slide, Mike. Also aftermarket. And then Wednesday, we've got a lot pre-market as well. So Tuesday, Wednesday, ton of companies reporting. Next slide, Mike. There's Wednesday again. And next slide. And by the way, any investors who would like to get a copy of this deck, we just reach out to us. We will provide a copy of it. Next slide, Mike. Thursday also a ton. So Tuesday, Wednesday, Thursday, a lot of earnings. Definitely some will be market moving. We'll be paying close attention to them. Again, we don't have a lot of tech earnings this week. So tech will probably be trading in this trading range until we get some tech earnings coming. But definitely, again, industrials, some consumer stocks, and some financials are also reporting. So we'll be paying attention to those. Next slide, Mike. Friday, we end very light day. That wraps up the earnings for the week. And next slide, and as we've stated before, if any investors or clients or prospective interested parties would like to learn more about our products and services, please schedule a one-on-one meeting or call with Cleveland Ashley. His number and contact information is listed here. And with that, it's going to be a very interesting week with earnings and some macro data and the presidential elections coming into their final days of campaigning. A lot of news flow, a lot of information. We do expect a lot of volatility, and leading up to the elections, we'll be on top of it. And we thank everyone for tuning in again this week. Mike, any closing comments before we sign out?
No, but I'm just watching this morning's pre-market move, and it's really very interesting. So can't wait for the 9:30 opening.
Okay. Take care, everyone. Have a great week. Safe investing. And we'll see you again next week. Take care.